Welcome back to The Explainer. Today, we're basically putting on our detective hats to demystify ACCA Advanced Audit and Assurance Batch 3 topics. We are moving way, way beyond basic auditing today. We're stepping into those complex, high-risk scenarios where your professional skepticism isn't just a nice-to-have skill, it's literally your most critical tool. If you want to pass this exam, you've got to think like an audit partner, and that's exactly what we're going to practice right now.
We've got a packed lineup for our investigation today. We're hitting value for money, estimates and fair value, auditing related parties, handling subsequent events, and finally, going concern assessments. Let's jump right in.
Section 1, Value for Money, or VFM. Our first stop shifts our focus over to the public sector. Unlike corporate audits, where we're mostly obsessing over profit margins and financial statements, here we're investigating performance. Specifically, how well do government programs actually utilize their funding?
As an auditor in this space, you really aren't just checking the math. You're evaluating what we call the 3 E's. First step, economy. Are they minimizing their input costs? Think about the cost per unit. Second, efficiency. Are they squeezing the maximum possible output out of every single pound spent? And finally, effectiveness. Are they actually hitting their stated targets? You'll be evaluating all of this using KPIs and benchmarks.
So, if you take away just one thing to cement in your memory for public sector scenarios, make it this. VFM equals economy, efficiency, and effectiveness. Oh, and remember, you're likely going to be providing negative assurance here, basically stating that nothing has come to your attention to suggest these 3 E's aren't being met.
All right, moving on to Section 2, estimates and fair value. These 2 areas are going to seriously build out our detective toolkit as we tackle ISA 540 and IFRS 13. Why? Because they are heavily prone to management bias. They require high judgment valuations, not just simple, hard facts.
Listen, your internal threat radar should be absolutely blaring right now. Management bias is a massive risk. You've got to independently challenge their assumptions. Are they using consistently over-optimistic growth rates just to inflate their asset values? Have they suddenly made unprompted, completely unjustified changes to their methodology just to hit a bonus target? You cannot just accept their word for it. You have to investigate. Now, IFRS 13 handles fair value through a really strict hierarchy of evidence. We drop from level 1, which is the gold standard, highly reliable quoted prices in an active market like stock exchange prices, down to level 2, which relies on observable inputs like standard interest rates. But the real danger zone, that's level 3. That relies entirely on highly risky, unobservable internal data generated by the entity itself. Because level 3 is essentially management doing their own math behind closed doors, we must aggressively investigate. You can't just tick a box here. You have to evaluate the appropriateness of their valuation models. You need to run sensitivity analysis. What happens if their assumptions are even just a little bit off? And most importantly, because these inputs are so complex and unobservable, you almost always need to bring in your own independent valuation specialist. So, lock this one-line cheat code into your mind before the exam. Whenever estimates, provisions, or unobservable fair values pop up in a scenario, your response should be automatic. You test their assumptions, you hunt ruthlessly for management bias, and you call in the external experts.
Okay, Section 3, auditing related parties. Let's crack open the case file on ISA 550. The primary risk here isn't a simple calculation error. It's hidden, non-arm's length transactions taking place between connected entities, like a parent company and a subsidiary, or maybe a director and the business.
So, how exactly do we uncover these relationships if management is deliberately trying to sweep them under the rug? We can't just trust the general ledger or the initial list management hands over. We've got to dig so much deeper to ensure completeness.
You must actively investigate, read through the board minutes, cross-reference the contracts, and scrutinize the share registers to spot any of those hidden connections. Once you actually find a related party transaction, you have to test it against the open market to see if it was legitimately priced at arm's length. And finally, you absolutely must get management on the record with written representations confirming they've disclosed all related parties to you.
Make sure you remember this punchline. The hunt is always twofold. First, you're searching for hidden connections to ensure completeness, and second, you're looking for shady sweetheart deals that don't match up with market prices. Oh, and if there's no documentation for a transaction, you need to start considering the risk of fraud.
Moving into Section 4, handling subsequent events. We are now entering the completion phase of the audit with ISA 560. Here, we're basically acting as time-traveling detectives to figure out exactly how to handle massive events. Think a warehouse fire or a major customer going bankrupt that happen after the year-end date but before the financial statements are published. The timeline here is critical to understand. From the year-end date right up until the exact moment you sign that audit report, you had an active duty to hunt for new evidence. You've got to read post-year-end minutes, review management accounts, and ask about new litigation. After you sign the report, that active duty ends. But if you happen to stumble upon something before the statements are officially issued, you still have to discuss it with management.
Understanding these two concepts solves the ultimate exam trap. How do you actually treat the event? It's pretty simple once it clicks. If the root condition existed before midnight on the year-end date, say a customer who was already struggling finally goes bankrupt in January, you go back and actually adjust the numbers in the financial statements. But if it was a brand new disaster that arose after year-end, like a factory burning down in February, you do not change the numbers. You only disclose the event in the notes.
Commit this single sentence to memory so you never stumble on the adjusting versus non-adjusting rules again. You have an active duty until the audit report, and you only adjust for what already existed. For the brand new stuff, you just disclose.
All right, final stretch. Section 5, Going Concern Assessments. Under ISA 570, we are dealing with the ultimate corporate nightmare, a company teetering on the brink of collapse. Assessing going concern is easily one of the most high-stakes judgments you will make as an auditor.
The standard is super strict on this timeline. We are looking at survival for at least 12 months from the reporting date. If you spot red flags of distress, things like loan defaults, bleeding cash flow, or the sudden loss of a major supplier, you cannot just nod along with management's rosy survival plan. You must rigorously challenge their cash flow forecast, test their assumptions, and figure out if their refinancing plans are actually living in reality.
Think of this as your ultimate cheat sheet for formulating the audit report. If the company is facing a material uncertainty, but management has been totally transparent and adequately disclosed it in the notes, you give an unmodified opinion, but add an emphasis of matter paragraph to point the user directly to that note. However, if management tries to hide the crisis with inadequate disclosure, you've got to hit them with a qualified or an adverse opinion. And if there are multiple, massive uncertainties everywhere, you just issue a disclaimer of opinion.
This one-liner perfectly resolves the whole going concern mystery. It gives you the exact reporting flow for applying the standards to a struggling client. Seriously, write this down because knowing this cold is practically guaranteed to save you marks on exam day.
As we wrap up today's explainer, I really want to emphasize the overarching theme of advanced audit and assurance. To pass this exam, you can't just be an accountant who simply adds up columns of numbers. You must act as an investigator. You've got to actively question the evidence, push back on management bias regarding estimates, hunt down those hidden related parties, and make the tough calls on whether a company is actually going to survive.
That mindset shift, that's exactly what takes you from a passing grade to an excellent one. So the next time you sit down with an exam scenario, ask yourself, are you just going to blindly read the numbers, or are you actually going to interrogate them? Keep that professional skepticism sharp, guys. Happy investigating.